All right, let's get into more perspective on today's jobs data and the impact on the markets moving forward. Let's get to Emily Roland, Hancock Investment Management Co-Chief Investment Strategist. Emily, always great to see you. So let's get right to the news today. Emily, what did you make of that jobs report, and what do you think it means for the markets?
Well, it took the markets a long time to figure out what everybody's been making of it. It's been a bit of a wild ride, and Julie pointed to that today. I think ultimately the report was weak. 142,000 is not too bad, but then those major revisions of 86,000. There were a couple of bright spots in the employment report, but I think weaker economic data was interpreted by the markets to be weak. And you're seeing that. The other element at play here is Nvidia, and when Nvidia is down, going to bring the market down, and then you have Broadcom into the mix. So some weakness in tech here. We did see massive multiple expansion in that space. So I think pretty reasonable that we're seeing those names take a bit of a breather today.
Yeah, and we should mention when it comes to the Fed as well, we heard from both Christopher Waller and John Williams today pretty much saying, yeah, it's time to cut. We still don't know by how much. Does it matter by how much from an equity market perspective? If we get a half-point cut, for example, does that show the markets that the Fed is worried?
Yeah, I mean, I think 50 basis points would show that maybe there's something that the Fed knows that we don't know as far as a recession coming. Right now the economy is decelerating, but at a nice, easy pace. We're seeing a lot of mixed data. Just this week, for example, job openings fell to the weakest level since 2021, but initial jobless claims came in really low. You saw ISM manufacturing take a move lower, suggesting contraction, but at the same time, ISM services remain buoyant and actually increase. So we want to, I think the Fed wants to make cuts sort of surgically here, move slowly. They don't want to spook the markets, I don't think, by going by 50 basis points here. But look, we have another inflation report coming up, more data to come on the labor market. So we'll need to see what happens here on September 18th.
So your playbook for the stock market then, Emily, what would you be advising? What would you be telling clients?
Yeah, we're advising that clients just don't reach too far for risk. We still want to be invested in this market. And at the end of the day, stock prices are going to follow profits or follow earnings. And the earnings backdrop's just fine, if not quite good. So we want to continue to be invested here, but we're seeing cyclical areas catch a bid. The weaker dollar has been helping riskier cyclical parts of the market like international equities. We really want to focus on quality here. These are companies with great balance sheets, lots of cash, great return on equity. The poster child for quality is mega cap tech. We like that, but we do have a valuation issue there with the tech sector, bumping up towards 30 times forward earnings. So we want to look at other areas of the market, quality at a reasonable price, if you will. So looking at sectors like healthcare, which are trading at a 10% discount to the broad market. And we're starting to also leg into more defensive areas of the market. Utility stocks, for example. We're looking at infrastructure related assets. We do expect to see a big shift in the consumer as people potentially push away from buying the things that they want to buy. Please tell my children I said that. But they're going to still do the things that they need to do. So we think that those more defensive areas of the market deserve a look in portfolios.
I want to come back to tech for a moment. When you say quality at a reasonable price, what would be a reasonable price? Because obviously the sector's come down. How far down would it need to come for it to look a little more reasonable to you?
It's a great question, but the challenge is that valuations have never been a great catalyst. I mentioned that the tech's bumping up on 30 times forward earnings. The valuations are elevated, but the earnings are elevated too. And frankly, the denominator has mattered a lot more to us. And you look at earnings for this quarter, the technology sector generated about twice the earnings results as the S&P 500. Revenue growth was concentrated in a handful of technology names. So we still like this part of the market given the elevated earnings trends, but we have to recognize that they're overbought as well. So I think it wouldn't be unreasonable to see a little bit of steam let out. But what I would really be watching for to underweight the sector is if there was some big shift in earnings dynamics. And we're just not seeing that yet.
Emily, can I get your thoughts on the AI trade as well? I asked because Broadcom reported. I think there were some who were hoping Broadcom was going to report and ride to the rescue. And after all, a lot of folks had moved into Broadcom because they saw it as a smart way to play that trend. But it did report, and right now we're down about 10% here, Emily. Just your thoughts on that mega trend.
Yeah, I mean, it's the same thing with Nvidia, where the earnings results were decent, but they almost had to be amazing to get investors to continue the excitement around some of these stocks. There was a lot coming into the price going into this earnings season. Again, really driving the market higher and seeing that multiple expansion. So, I think it makes sense here that these names are taking a little bit of a breather, but we still want to own them in portfolios given the high quality nature and the earnings drivers that are inherent in the space.
Emily, I got to get in a bond question. Let's talk about how you're currently thinking around the Treasury market specifically here, right? You would think the Fed's cutting, yields are going to come down. They have come down some, right? But kind of within a range here. So what do investors do with that?
Yeah, Julie, we would be looking again at every backup in bond yields as an opportunity to lean into high quality bonds. We still see the income as very attractive in bonds. The aggregate bond index now yielding about 4.25. What we do see, there's this debate going on today about 25 versus 50 basis points for the Fed. That's cute. Right? The Fed normally, on average, cuts 17 times, and the 10-year Treasury yield falls on average 2.5% to 3% during those periods. So we want to be looking at the total return potential that it's inherent in bonds, not only from duration, but also from the income. We might have to wait a little bit for the duration part to kick in, but you can get paid to wait, given that income is near the highest in over 15 years.
Emily, great stuff. Always good to see you. Thank you. Appreciate it.
Me too.